Hello, welcome back. Here is Ali Talabi, and this is module 9. We're actually going to wrap up this module by looking at some notes, some hints, and some questions. So let's start this lesson. So in module 9, we talk about the cash flow estimation, and I showed what type of cash flows you need to include in the project, what type of cash flows you shouldn't, and also we talk about operating cash flows in this module. So one of the major notes here is regarding finding the present value or the net present value of the project. So in module 8, we talk about capital budgeting and we introduce several techniques which you can use to find the right project. However, remember that the cash flows you generate, you calculate, you estimate are the nominal one, which means the inflation is part of that. If you decide to exclude the inflation, which means you want to take out the impact of inflation, the result becomes a nominal cash flow. So can you do that? Yes, for sure. You can take out the impact of inflation, you can adjust for the inflation, and you can end up having the nominal cash flow. If you decide to use the nominal cash flow, just make sure you go with the nominal discount rate or the nominal cost of capital. Don't use the real cash flows uh, with the nominal discount rate or vice versa. Just make sure that you are considering this proverb which is saying birds of a feather flock together. Nominal cash flow, nominal interest rate, real cash flow, real interest rate or real discount rate. So be careful with that. We talk about the cash flows which you have to include in your calculation. Make sure that you include the incremental cash flows, you include the relevant cash flows, and you are excluding all irrelevant cash flows, such as the sunk costs. We talk about the sunk costs, which you shouldn't include. Another major note here is that for operating cash flow, we talk about different approaches, and I mentioned all those approaches will lead to the same number. Given the information or the inputs you have, you might choose one over another, but at the end of the day, the answer should be same. If you don't get the same answer, it means that you've made some mistakes. Uh, Another important note here is regarding the cost of capital. So companies are running different projects. The cost of capital for the project for one project is not necessarily same as for other project, even for the same company. Why? Because the risk level of the projects is not same. So some are kind of riskier, some are less riskier. So in this case, you have to use appropriate discount rate for that specific project, which is not necessarily same as the cost of capital for the company. So if you have both the cost of capital of the firm and the cost of capital for the project, just make sure you use the cost of capital for the project, not for the firm. And also we discussed regarding the differences between the net income and the cash flow. Here we are more concerned about the cash flow, not the net income. For sure, we can use the net income. We can make some adjustment to calculate the cash flow. Now let's look at the questions. The first question. So we're talking about the equipment which costs you $5,000, and we know the book value $2,500 and the market value $4,000. Now let's ignore the tax impact. What's the correct opportunity cost for this equipment in the capital budgeting decision? So when it comes to opportunity cost, remember the most relevant number is based on the market data. So it doesn't matter how much you paid for it because it is kind of sunk cost. It doesn't matter what's the book value because it is mainly for accounting purposes. The major relevant number which you have to include here is the market value. So in this case, $4,000, that's a relevant opportunity cost you have to consider in your capital budgeting decision if you are going to use that equipment in your project. So the answer should be C. Let's look at the second question. So we have information regarding current assets and current liabilities. More specifically, we have three items here. And our goal here is to calculate the changes in net working capital. When it comes to such questions, there are several ways. Either you can calculate the current assets in the beginning, minus current liabilities, and then calculate the current assets minus current liabilities at the end, and then you find the differences. Or you can go account by account. So you can calculate the changes for each account and to see the impact. So let's start with the second approach, which is my preferred approach. It's much kind of easier. So what's happening here? As you see, your accounts receivable is going down by how much? Yes, $2,500. Now, we learn when the accounts receivable is going down, that's a good sign for the cash. So any reduction in the current assets, it means you are getting cash, so you're converting into cash. So the cash flow is going up by $2,500, positive. What about the inventory? The inventory here is going down as well. So that's another good sign. You're generating or adding another $1,000 to your cash flow. So your cash flow is going up by $1,000. What about the accounts payable? Now, here your accounts payable is going down by $2,000. We argued that for current liabilities, the changes in current liabilities is working on opposite side of the current assets. What does it mean? It means if the current liabilities are going down, it means you pay them off, which means that the cash is going down. So $2,000 reduction in accounts payable is equivalent to $2,000 reduction in the cash flow. So it should be minus $2,000. Now let's add all these numbers. 3,500 minus 2,000, it should be $1,500. That's the positive, so your cash is going up by $1,500. So the answer should be B for this question. So let's look at the next one. Which of the following should be included as a cash flow for project evaluation? So we talk about the relevant costs or relevant cash flows and incremental one. So we talk about some costs which you shouldn't include in the cash flow, such as the sunk costs, such as the financing costs. So here we are talking about those items which should be included as a cash flow. So let's go one by one. The financing interest costs of project. I mentioned you don't include the financing or interest cost of the project. That's a different story for the cost of capital. Here we just focus on the cash flow estimation. So A is not the answer. B, the $1,000 increase in the sales from existing products due to this project. So we talk about externalities and when you are talking about the impact of other products on the current product or the current project. So you should include those costs or revenues. The impact is called externalities in our calculation. If the impact is negative, it's called actually cannibalization. So, but here we talk about positive impact. The $2,000 that was spent to renovate the project plan. Now, the $2,000 you already paid. That's the sunk cost. You shouldn't include for the current project, for the current evaluation. The $10,000 increase in the current assets of the project, for sure, due to the project. For sure, when it comes to current assets, current liabilities, we talk about the net working capital. Any changes should be included. So the answer, the D should be included. So far we have B and D. So the only answer here becomes E, which covers both B and D. Part of the cash flows which you have to include in your calculation. So let's look at the last question here. A project generates revenues of $1,000, the cash expenses $500, and depreciation of $100. The firm tax bracket is 30%. We're looking for the operating cash flow. So we talk about different approaches. So one way here is just to calculate the net income, net profit, and add back the depreciation. Or we can go with the second approach. Both should lead to the same number. So we'll start with $1,000 minus $500 minus $100. So this gives you $400. You are paying 30% tax on this. So in other words, 70% is left for you. So your net income here should be $280. So $280 is your net income, net profit. However, you have to add back the depreciation expense, which was $100. So if I add back 100, my total cash flow from operation should be 380, which means A is the correct answer. That's it for today. Thank you very much. Here is Ali Telebi, and this is the end of Module 9. Have a wonderful day. Talk to you soon. Take care.